Good morning, everyone. We're just going to give it another 60 seconds for a few more people to funnel in, and then we'll kick it off. All right. Well, we appreciate everyone taking time to join us this morning and go through the February webinar. So I think everyone on the call should know me at this point, but I'm Justin Ferraccio. I've been with the firm now for almost 5 years. I'm a partner out here in the Denver office. And on the phone in Harrisburg today, we have Chuck Eberly.
Hey, everybody. Welcome from Harrisburg.
One of the founders of the firm. So let me go ahead and kick off. We'll get started. So just kind of a reminder of why we do this, and the purpose of this meeting is, Chuck and I had talked about doing a monthly newsletter, some sort of, monthly touch point with clients and prospects and friends of the firm. We thought that a webinar would be a better use of your time, more interesting forum. So this is meant to be, provide specific updates on economic conditions, portfolio, bring in guest speakers, monthly updates that are interactive and hopefully interesting for you. We'll talk about what's going on in the market today with stock market performance. Today, we're going to talk about portfolio analysis. So how we're kind of thinking through changes we're making here at the beginning of 2025. Then we're going to talk about Aptus, which we'll get into in a few minutes. We have 3 pre-submitted questions today, so appreciate that. And if you have any questions on this call during the meeting, you can send them directly to the chat. They'll come to me directly. They'll be anonymous, and we'll do our best to answer those in this call. If we don't get to them or they're, of a personal nature, we'll reach out after the meeting and have those conversations. Okay, so just kind of a quick look at where the market is year to date. Dow's up 4.5, S&P is up 3, NASDAQ, which is more tech focused, is up 2. Russell 2000, which is more small and mid-cap companies, up 2.5. Equal weight S&P, so that takes the 503 stocks in the S&P 500 and weights them all equally. The return of that's about 3.4. And then the bond market is returning a little bit above 0.5% right now. So I think the interesting takeaways on this slide is, one, the equal weight S&P is outperforming the S&P, which we haven't seen for a long time now. And that's a result of, one, there's been a lot of volatility at the beginning of the year. So I know that's the question we're getting a lot, is there's a lot happening in the market. There's some concern about what's happening in the market. The market's actually performing well or even above expectations for only 6 weeks into the year. It's just doing it in a pretty choppy manner, right? So that's allowing the equal weight S&P to keep up and outperform, because there's a lot more stable companies in the S&P. It's not as relying on tech and specific holdings individually, like Google, Apple, Nvidia. So performance has been strong. It's just how we're getting there is choppy. So we spent a lot of time talking about, Chuck and I and the investment team, talking about portfolio analysis, right? So this is something that we're constantly looking at. We wanted to give you a little bit more insight into how we think about this today. So we manage money through diversification of sectors. So we don't believe in investment pies that say we have to have a certain amount of money in international, a certain amount of money in emerging markets, large cap, small cap. We look at it as how much money we want in specific sectors of the economy, which I'll show you more. The next slide will have more details. But right now we're constantly looking at that, but we're just adjusting the sector allocations a little bit. Now we're making tweaks. They're not major changes, but it's 1% or 2 here and there. And I'll show you what that means more specifically. Secondly, we're looking more at individual security allocation. And this is due to the success of certain companies over the last several years, that we need to trim those positions and that will get the risk profile back in line and ultimately help with long-term performance. So good examples of that are companies like NVIDIA, Google, Amazon, Meta. Those companies have done so well recently that if we want them to be 3 or 4% of your portfolio, some situations they're 6, 7, 8, 9% of the portfolio, and that's because of the success of those companies. So those positions in retirement accounts, that's kind of easy for us to manage, take care of, reduce those positions, realign risk, because there's no tax consequences. But when those positions are held in taxable accounts, those will be kind of one-off discussions where we talk with you specifically about our plan, our tax plan, pros and cons. But really, it's the way that we think about money and risk. We don't want to look down and see 6, 7, 8, 9% of your money in one specific company, even if it's a great company. It's too much risk associated with that position, and we think that we can pivot that money around into other sectors within the same sector that position's held, or other sectors of the economy, to reduce the risk profile, and then ultimately, over the next market cycle, enhance return as well. Chuck, you want to add anything there?
Yeah, I'd say, when you look at individual concentration of companies, I think that's one of the hardest things to deal with, because when you look at that and say, wow, we had all this success with owning certain companies. We do want to let those things run and benefit from owning a good company. But at some point, it really gets to be, it changes the risk profile. And what we don't want to have happen is some event that would cause damage to a certain company, and then give us more downside exposure. So it's definitely something that we'll be reaching out. Certain clients have more exposure than others, but it's an individual discussion, especially with taxes. But our view is that we don't want to let the tax decision drive the investment strategy. It's let the investment strategy come first, and then always consider taxes. But if you consider taxes first, usually you don't take care of that overexposure. So it's definitely a combination. But I think the first factor is investment strategy, then taxes second.
So move on to the next slide to kind of show a little bit more detail about how we're thinking about sector allocation right now. So we're looking at 12 different sectors of the economy, right? And you'll notice our beautiful colors. Yellow means that we're looking to be underweight that sector. Gray means we're looking to be equal weight. And green means we're looking to be overweight. And that's all compared to the S&P 500. So an example, if you look at the S&P 500, what percent of the S&P 500 is tech companies? It's 32 or 33%. So, we're targeting closer to 25. So we're underweight that specific sector. Now most of these sectors, we're talking about overweight or underweight by 1%, 2%, 3% at most. Tech is the biggest discrepancy you'll see, with the S&P being low 30s and us being 25. And again, that's a function of us thinking about how to mitigate risk, where we see potential market corrections happening, and we see them happening in the tech sector. We think that's the most overvalued sector. Doesn't mean it's bad. It just means it carries a little bit more risk. One other thing to point out is, when you think about specific companies like Google, Meta, which is Facebook, those companies in the S&P 500, how we think about them as sectors, they're listed as communication companies, right? So they fall into that 7% communication. But, when we think about them as cross correlating between two sectors, between tech and communication. So if tech goes down, communication goes down, because again, Google and Meta kind of track that sector. Same when you look at consumer discretionary, that's going to have Amazon and Tesla. And so you can easily think about Amazon and Tesla as tech companies, but technically they fall into consumer discretionary. So that, again, this is how we kind of think about specific weighting, right? So other things we're thinking about for this year is underweight healthcare. The S&P is about 10% healthcare. We're closer to 8.5%. And again, we see headwinds right now in healthcare, specifically companies like Merck and Pfizer, companies that make a large portion of their revenue through vaccines, immunizations. With the current administration, we don't think that Pfizer and Merck are going to be bad companies moving forward, but we do think they have headwinds. We do think that they have potential problems they need to solve, right? Whereas on the flip side, energy is about 4% of the S&P. We're closer to 7. We see great opportunities in energy under this administration. We could have a discussion about, us creating more oil drives down oil prices, and it may. But I think long-term, looking at these, large energy companies, Exxon, Permian Resources, Chevron, we think they're going to do well during this next cycle. Utilities is another one. Utilities is only about 3% of the S&P. We're 4.5%. So when you think about utilities, it's companies like Duke and Sempra, energy, those types of companies. And the reason we like them is because of AI. It's because of Bitcoin. It's because in order to power these things we're doing in tech, it requires a tremendous amount of energy. So we really like utilities moving forward. So just wanted to share this with you. Again, we're not making major calls. It's more of a risk mitigation tool. And it's us trying to be forward thinking about how we can pivot a percent or two from one sector to another to get better returns with a lower risk profile. Chuck?
Yeah, I think along with that, the next part of the discussion is Aptus is a company we engaged with. We started this search probably about a year ago. And what we were looking to do was to get more brain power, more people looking at the portfolio. So, first we were looking at, how do we do that in-house? Hiring a chartered financial analyst at SevenBridge. And we were looking to hire 2 people. And then we kind of changed our thinking with that. Well, what if we look for a company that's in this space that could help us, that their thinking and strategies align with us? So we interviewed a bunch of companies. Aptus is a firm that manages about $5 billion. They run their own portfolios. They manage money for other firms. And what we engaged with them was to sit on our investment committee, bring their equity specialist, their fixed income specialist, their portfolio strategist in on our investment committee, which we did probably signed up with them about 4 months ago. And since then, we've been looking at, sector weightings and individual holdings and risk. So our investment committee before was all in-house, so it was, internal people at SevenBridge running a strategy of owning quality, looking for companies that pay dividends, grew them every year, looking for companies with growth, managing the bond portfolio, which we've done for, about 3 decades. But we definitely wanted to build the team out. We found that Aptus is a perfect choice for us. And the names, you see some faces on there. Dave Wagner is Aptus's head of equities. So we've had a lot of discussions with him about, each holding. And, what we're looking to do is, within those sectors, there's been some companies that we've all talked about. And I know, during our review process, we're talking about, like companies like Nestle and Roche and things that really, didn't perform as well as we wanted. So we're looking to pull some weeds in there. But Aptus will be, basically what we do about every other week, we have a meeting. Especially we've had a lot more recently, but I'd say every month we'll have an investment committee meeting, review everything, sector weightings, individual holdings. Our plan is for the next webinar is to have key members from Aptus that are on our investment committee at the webinar next month. So you'll get to meet them and ask them questions. But we're really excited to have them on to assist us with this. All the decisions will still be made in-house like before, but we're gonna have a lot more brain power to hopefully make better decisions and more timely decisions. Anything you want to add there, Justin?
No, I think you hit the nail on the head. I think the important thing is important thing to know as clients is we're not using Aptus, their portfolios, their investment strategy. It's still our portfolios, our investment strategy. We're just utilizing them to have more horsepower, more brain power behind the decision making that we're coming up with, right? So it's just a value add. They have people on the team that focus on private equity. So if, investment opportunity pops up and you want analysis on it, people usually ask Chuck and myself to look at it, and we do. But now we have a third party that can also look at it and do a write-up, help think through questions that we may have missed. So it's just, again, I think an upgrade, and that's about it. Chuck, do you want to touch on Larry?
Yeah, I think another point, I've had this question a couple of times, but I've individual meetings and conversations with clients. The question was, what does this cost us extra? Does the fee that you pay SevenBridge remain the same? And the answer is yes, it does. This is a cost that we're absorbing. So definitely not an upcharge. I think most of the people we've had individual conversations with, Larry DeFlory, who founded SevenBridge with me, decided that he wanted to, due to health reasons, take an early retirement, and that is taking place. It's not complete yet, but I'd say, here in the next month, Larry is stepping aside. Justin will be a partner of the firm and owner of the firm, and we're in the process of doing that. So wanted to point that out, but any questions you have on that, reach out. Happy to talk about it, but excited to have Justin as a owner of SevenBridge and a partner of the firm.
Thank you. Okay, so now we'll dive into the pre-submitted Q&A. And again, if you have questions, pop them in the chat and we'll take a look. This is by far the most frequent question we're getting, and we're getting it in many variants. So Chuck, talk to us about your thoughts, the firm's thoughts on tariffs, what's happening with that right now, what Trump is doing, and what the market implications look like.
Yep. So a lot of talk about tariffs, and it depends. One side, tariffs are scary. It's going to add to inflation. It will cause a recession. On the other side, you look at it, it's more of a, I guess, a negotiation tool to get things more in line. I was reading an article this morning talking about total consumer spending in the United States. It's a large number. And if you took that part of consumer spending that comes from imports, and if tariffs were placed on 25% tariff on every single imported item, it would add about 3% to overall consumer spending. So 3% to inflation. So that's a big number. It's kind of a small number compared to what we've been dealing with. So there is an inflation factor to tariffs. I think this is an item that we don't need to be afraid of it and run away from it, because there's just too much to understand. What will actually go into place, what's the actual result of it. And I don't think they're all negative. So we're cautiously, paying attention to what's going on with the tariffs. But at this point, we're not making the assumption that it's just automatically going to be bad and something we need to run away from. But it is part of, we're always concerned about risk mitigation, overexposure. That's something we're always watching, which tariffs are part of that. So we think by, carefully adjusting the sectors, looking at concentration, we could solve the problem of a negative impact of a tariff.
Right. Okay, where do you see rates going in 2025? I can take that one. So
Please do.
I think if you would have asked us this question middle of last year, 6 months ago, the answer it would have been very different than it is today. I think 6 months ago, our expectations were we'd see 2, 3, 4 rate cuts in 2025. Um, you know, that's not going to happen. I think that's pretty clear at this point. Current expectations are for the whole year are between 0 and 2 rate cuts, with kind of current expectation of one quarter point rate cut. So much less than I think we expected, again, 6 months ago. And that's due to all the economic data that's coming out about inflation, jobs reports. Just the Fed is not seeing a reason to continue to cut right now. So it's, again, something that we monitor. It is impactful for the market. And I think something that's important to note is, the market was pricing in 3, 4 rate cuts for this year. The market already knows that there's not going to be, more than 2, probably 1, maybe 0. And prices they still are where they are, even with that kind of news priced in at this point. So I think that's the good takeaway is the market has realigned expectations and is holding up reasonably well. But we'll continue to talk about rates probably during every webinar this year.
I think the nice thing about the whole rate discussion is not as prevalent as it was before. Now we're getting back to fundamentals of earnings and growth and the things that really matter. Because before it was all kind of hinged on what the Fed's going to do. I think it's a good thing that the focus is moving away from interest rates more and more, where we're getting back to more fundamentals and how companies perform.
Great. And then last pre-submitted question is, should I be concerned about the Magnificent Seven? So the Magnificent Seven are the 7 largest companies in the S&P. It's Microsoft, Amazon, Meta, Apple, Google, NVIDIA, Tesla. And just to point out a couple of things before Chuck answers, obviously NVIDIA took a big hit a couple of weeks ago with some news coming out of China about a potential competitor. Google has taken a hit over the last week over, guidance and earnings. Apple's taken a hit. Tesla's down 5 days in a row. So Chuck, you want to talk about our thoughts on these companies?
Yep, for sure. If you think about the last 2 years, most of the returns of the S&P 500 have been from these 7 companies. As a matter of fact, if you took those returns away, there wouldn't have been much return in the S&P 500. So the last 2 years, the more you owned of these companies, the better you did. Which, so far this year, the more you own of those, the worse your performance is. So you look at our average portfolio, we're actually, outperforming the S&P, mainly because we've managed exposure, to these 7, more as a risk mitigation tool. But I think you do need to, we need to look at exposure to these companies. One thing about leadership in the top holdings, the top 10 holdings of the S&P, you go back, 20, 30 years and you see how that leadership changes. We think that change will continue. We don't know when, the top companies are going to change, but they do. It's not permanent. So we want to have exposure to these companies, but we want to manage it. It's important for managing downside risk, but also managing the returns. So that's something we've been focusing on and will continue. What's going on with the Magnificent Seven? How long will it continue? And you go back through history, many times it's been, the Nifty 50, you go back through time, there's always a name for these companies that are magnificent until they're not. So it's something to be aware of and keep an eye on.
Yeah. And they are still great companies. There's no major red flags at this point. But as Chuck said, it's just managing exposure. And it goes back to what we talked about earlier in this presentation. It's, we want to own those companies, 2, 3, 4% positions in those companies. But when we start drifting above that, it's just where we need to have more conversations. And again, the reason we've drifted above that is because of the outperformance those companies have had over the last 2 years specifically. So that gets us through our content. There's been no questions in the chat, which means we've answered everything amazingly. So again, this is not meant to be any sort of substitute for your normal cadence of meetings with us. It's just additional information. So if you do have a question specifically about your account, about the economy, about anything, reach out to us directly and we'll have those conversations. But we do really appreciate you taking 30 minutes. I know it's supposed to be 15. We usually drift over. So we thank you for your time. And hopefully everyone got something meaningful out of it.
Thank you, everybody.
We'll see you next month.
See you.
Bye.